This week, I started by writing about the OPEC Plus oil production cut extension. And that extension was primarily aimed at weak global oil demand. I showed from the US Energy Information Administration's short term energy outlook that global oil demand shrunk in May year over year. And that's only the second month in the past 39 months in which that's happened. And we've seen oil demand become weaker, oil demand growth become weaker and weaker over the past year. So it's not surprising that OPEC Plus would target the market for an extension at this point. And one of the more interesting elements of it was in some of the reporting around the announcement, there was an OPEC Plus official that acknowledged they were trying to offer some clarity to the market out, say, a year and a half into the future. And that was interesting for a number of different reasons. A big one is that OPEC Plus, any market watcher understands how much uncertainty exists in oil markets, specifically around demand in the medium term to longer term. And OPEC Plus understands that investors, oil producers, anyone with a meaningful stake in this sector is trying to capture as much clarity as they can over longer periods of time. So for that element of the cut to be acknowledged explicitly was worth noting and led to a pretty notable development in oil markets this week. My second post was about natural gas pipelines here in the US. And we're going to see more pipeline capacity come online in 2024 than we have since 2008. So it's a pretty big boom in construction and in these lines coming in service in 2024. We're seeing a bunch of drivers around that. LNG, of course, is a big one. But we're also seeing some more takeaway capacity get added up in the Northeast. So this is aimed at trying to help unlock more of this natural gas that is either getting trapped or not being produced in the first place to find more end markets, which should help natural gas prices rise a bit off the floor that they've been living on for the past, for most of this year, frankly. My third post was about oilfield services debt financing costs. We've all known that global interest rates have gone up over the past 2 to 3 years, and yet, very interestingly, oilfield service costs have gone down over that same period of time. And what has largely happened is oilfield services as a sector captured a lot of record profits coming out of the pandemic's recovery. And they used some fraction of that profits to strengthen their balance sheets. And when you have stronger balance sheets, it means A, you get to pay less to finance the debt that does remain. But B, you get a lot more optionality around how to deploy your cash, whether you want to invest back in the business, whether you want to distribute cash to shareholders. And oilfield services, the message here was largely around discipline. That oilfield services saw these record profits and made sure that they took a fraction of those profits and used it to pay down debt to give themselves the optionality that they know they will need going forward in an oil sector that is increasingly uncertain, as we talked about with the OPEC Plus production cut extension. My last post this week was about US E&P employment. And we're seeing more crude oil production in the US per E&P employee than we've ever seen on record for at least the past 50 plus years. And this has really only happened over the past 10, 12, 15 years. Some of it's pretty obvious. We've had new technologies, horizontal drilling and fracturing, that have led to a lot of efficiency gains. But here in the past 2 to 3 to 4 years, we've also seen this consolidation push that has led to the identifying and harvesting of synergies, which in many cases means headcount is going to go down. And so we've seen as oil production has continued to climb, headcount has stayed more or less flat, given the drop that the sector experienced going through the pandemic. We've really not seen a headcount recovery. And with the way that management teams and investors are talking today, we should really not expect a headcount recovery from here. So these record production efficiency, production intensity levels that we're at when we talk about employees, there's no real reason we should expect that to change meaningfully in the near term. Each week, I send out a free weekly newsletter that I call the Business of Energy. It includes links to and summaries of all of the research that I publish online during the week. So that way, if you've not seen it all or not keeping records of it, you have it all in one place. I also include an energy-related anecdote, insight, or observation that I don't share anywhere else. So that way, even if you've seen everything that I've published online, you will still have something new to read in the newsletter. If you've not signed up to receive that one, you can either hit the link in my profile or I'll put the link down below as well. Thank you so much, as always, for reading, watching, listening, commenting. I really appreciate it. I hope you had a fantastic week, and we will talk soon.